Hello everyone and welcome to this special webinar from Fat Profits. My name is Roger Malik, the Head of Client Services and your host for today. Joining me in our Fat Profits studio here in Sydney is firstly our resource analyst, David Lennox. David, welcome to the webinar. How are you today?
Hi Roger, I'm good and certainly happy to be part of this special webinar.
Great, good to have you on board, and I'm sure our audience is looking forward to hearing your views, especially on the commodity side, but otherwise the markets as well. And of course, joining us as well is our Senior Account Manager, Chris Balafas. Chris, welcome to the webinar. How are you?
Good, Roger and David. Nice to see you guys and nice to see so many attendees today.
Yeah, we do have a lot of people. I suppose the way the markets are, people are interested to find out what Fat Profits got to say and where we see the markets in the near term. So we've got a lot to talk about today. But before we get into the discussion, a bit of housekeeping. All our presentations from Fat Profits are general information only. We don't take your personal situation into account. So if you're looking for personal advice, please see your financial planner or advisor. And also past performance is no indicator of future performance. Now we like to make it interactive as much as possible. So if you have questions, you can type them on your screen and we will take them towards the end of today's webinar. However, if we're talking about a particular topic and you want to discuss it then and there or clarify something, please feel free and we'll be happy to answer those questions as best as we can. Now, first thing first, let's get ahead with the market update. So there's a lot happening in the market in the recent past, and the big talking point, of course, you can't go watch any TV channel these days without hearing about inflation. And let's have a look at Australia's inflation first. And recently we heard the inflation figures came out for the second quarter of this year, and although they were below market expectations of 6.3%. So we've come in at 6.1%. It's still a concern for the government, and it's a concern for the Reserve Bank. David, I'll probably get your thoughts. I mean, yes, it's below market expectations, but rising inflation will definitely affect consumer spending, and it's a concern even for homeowners and investors alike. What are your thoughts where this is headed? I mean, the Treasurer said we can expect up to 7% and beyond.
Primarily, we're seeing the Reserve Bank lifting cash rates to try and, in fact, slow the inflation rate that you can see from the chart in front of you. What it does is it does hurt real revenue or real wages and the ability of people to buy more or less of the goods and services that they wish to use to live by. So primarily, as we see this number rising, it does continue to further hurt the spending power of the populations around the world, including Australia. And we do think that there's probably a little more to go. We haven't as yet seen the peak in the Australian inflationary cycle here, so we are watching very closely. Probably that 7% is not far off, but certainly at this point in time, if you have a look at our 6.9, we are still well below some of the other major economies, such as the US, which has now got a high inflation rate of over 9%, and also what we're seeing inside the UK and Europe. So not too bad a position for Australia to be in. Yes, our inflation's rising. Yes, it is hurting the pockets of everybody, but the Reserve Bank is now in tightening mode to actually bring that inflationary number under control.
That's it. Thank you, David. And talking about the US, we all know the US inflation is well and truly higher than Australia. They're currently sitting at 9.1% and tipped to probably stay around those levels for at least some time to come. And of course, the Federal Reserve in the US have raised rates to 2.5% now, which has gone back to sort of 2018 levels. And the expectation is they'll probably sit around between 3 and 3.5% in the coming months. With Australia, a cash rate, we're probably looking at 2.5 to 3% over the coming months. So we'll keep an eye on that. Moving on to the recent announcement from the US, and this is another big talking point, is the recession in US that everyone's forecasting. And we recently saw the GDP numbers come out for the second quarter, and we've seen 2 quarters in a row where the GDP has actually gone backwards. And technically, that is the definition of a recession. However, people are not still worried. This is not a real recession, as most economists are saying, because the employment or the unemployment figures are still very low. There is a lot of people in jobs. Corporate sector is still in good shape, so they haven't felt it yet. But Dave, what does Fat Profits think? There is one likely to come, a real recession, probably sometime next year in the US?
Look, certainly there's the possibility of that, as we see the central bank there lifting interest rates to do just that, to slow the US economy. So one would expect if they are raising those rates to slow the economy, then that's jolly well what's going to happen. Yes, you can see from the chart in front of you, we have seen technically already a recession with 2 negative quarters. But going forward, as long as the Reserve Bank and the Federal Bank in the US is lifting rates, then they may make the error of going too fast, too quickly, and too high, and slowing the economy too much, and bringing with it on a recession. But as Roger said, the corporate sector is well cashed up in the US, and we're seeing reportings at the moment from US companies suggesting that they're still in fairly good shape. And of course, we've got very full employment, not only here in Australia, but in the US. And they're two metrics that basically aren't the commencements of a recession. So really, it's going to be all up to the Federal Reserve. If they act too quickly and too high on the interest rates, then they're going to be probably the sole cause of the recession.
Yep, thank you, David. All right, just have a quick look at the world GDP forecast. They've been revised down, and you can see majority of the countries are now expected to shrink over the coming months and the next 12 months in particular. Australia, they're expected to be pretty flat, and that's a better position than most of the other economies. Hence, we were a bit more optimistic about the Australian market versus the others. And also now moving on to what our positions is. So our CEO, Angus Geddes, provides market direction to our members. And recently, these are some snippets from his daily emails that he sends to members. And I won't read everything, but he's highlighted there's 3 risk arrows facing financial markets. And however, he still believes that Australia, Japan, and the UK will outperform other countries like US, for example. And on the right-hand side, the one thing I will read is at the bottom, he says that we believe the US market could consequently have further room to move lower over the 3rd quarter, and subsequently removed nearly all US exposure. So at the moment, Angus has improved his cash position, and he's waiting for further volatility in the 3rd quarter before buying back again. So these are the kind of important updates that our CEO Angus provides to our members every morning. And you can hear from him directly, he's a fund manager, as to what he's doing with the cash, whether he's going in or he's seeing some volatility where he's expecting to sit out. So the next thing to look forward to is our earnings season, which has now gotten underway. And over the coming weeks, we will see Australian companies report their full year earnings and the forecast. Now, this is a quick look back at the last earnings season in February, where we saw a lot of companies reporting good profits, sitting on plenty of cash. There were buybacks announced, even dividends were raised by 52% of the companies, 11% maintained it, and a few cut it. But all in all, the corporate sector in Australia was in good shape. Now, this upcoming and now commenced reporting season will be keenly watched, and we will be providing some updates to our members over the course of these few weeks. Finally, looking at the ASX now, we know that the ASX is very different to other markets where financials and materials form nearly half of our market. So they're very important to the overall market direction. When talking about market direction, Dave, I might ask for one more input from you. Just looking at the ASX 200, we've seen the recent drop and down to 6,400 points where the ASX 200 found support, and it's now bounced up close to 7,000 points. How do you see this for the remainder of this year into the next 6 months?
Certainly there's going to be some volatility in the ASX 200. We will be looking to the current reporting season that Roger has just alluded to is now getting underway. to give us some direction as to where companies think their futures are going, and also where they're forecasting guidance. So while we see the tightening cycle around the world, that is interest rates being lifted, we do think that yes, there's going to be some volatility, but you can see there that our market has done relatively well compared to a number of other major equity markets. And that is primarily because a number of our metrics, such as inflation, we have full employment, we've got very strong trade credit numbers. They're all pointing to an Australian economy that should remain relatively buoyant. And if that's the case, and we do see some very good reporting numbers coming out of Australia's corporate sector, then one would expect to perhaps see a further uplift in that chart that you can see in front of you. However, the caveat is that yes, we are still in that rate tightening cycle. September and October can sometimes be difficult months for equity markets, so we're watching very carefully to see that we don't get over exuberant about where the current rally is, and we make sure that we've got some powder left to pick up opportunities should we start to see that pullback that we may be expecting come September, October.
Very good point, David. So keep that powder dry, and certainly there'll be a lot of opportunities in the coming days and weeks. So we will be updating our members. Now, talking about forecasting, that's one thing we do at Fat Profits. So we provide a forecast and a market direction of where we see certain things going. However, you know, this is something as an investor, David, everyone likes to or tries to forecast and predict. However, there is a bit of a concern sometimes when you're reading the news or watching what's going on. If you look at this example here, recently JP Morgan came out and they said they expect oil prices over the next 1 to 2 years to skyrocket up to $380 a barrel, which is crazy if that was to happen. We'll be paying through our noses at the pump. However, yes, on the other hand, we had Citigroup who's saying they're expecting $45 to $65 a barrel. So this is really confusing for mums and dads out there. I mean, if you look at where oil is at the moment, it's just under $100. You know, what's Fat Profits think of these predictions, and what do we see oil price at?
Look, we tend to use thematics when we look at sectors, and from those thematics, we then look at companies that might suit our thematic. Our thematic long term is for oil, yes. In the near term, it will probably move to the higher side. But when you have a look at what's happening across the broader, especially auto industry, and the move by that industry to electric vehicles, that's certainly in the future going to diminish the demand for oil. So one would expect over the longer term that we would see the oil price perhaps not near the $300 over the long term, but put more than likely down towards the $45. As I would say, probably both banks may be right. But what we do is we use those thematics, we look at them long term, and then we best move into the companies that we think will suit those thematics. For oil, it will be very volatile, yes. The war in the Ukraine and between Russia and the Ukraine has done that, but we do expect if that war does come to an end, that we would see a more normalized market, and with that in the future, perhaps slightly weaker oil prices going forward than we perhaps see at the moment.
Yep, absolutely. So there is, and especially if the recession in US next year does come true, then that'll reduce the demand as well across a few countries. So something to keep an eye on, and we provide these updates to our members and the positions in oil stocks, whether to sell at the right time or to hold, because currently we're holding. However, when we see some concerns, we will look to sell these stocks, and these are the kind of updates. So Chris, over to you. There are some concerns which are gripping the market, so over to you to highlight a few.
Yeah, well, let's hope, Roger, that JP Morgan's predictions are wrong with $380 barrels. But yeah, look, the markets have been quite volatile this year, as we can see on this page here, especially in June, with the sell-off being its worst in 2 years. And we've already touched on it, Roger, to the listeners today. You know, the US inflation higher than expected, and the RBA in America just continuing to up their interest rates, and they're going to be doing this a few more times this year. In fact, as you can see, the biggest US rate hike in almost 30 years. And the fear, well, it's the uncertainty, the fear of a global slowdown and a recession. But with all that said, the next slide does show that there actually has been a lot of good performance, Roger. And as you can see, the miners have done exceptionally well. Lithium, we've been very bullish on lithium, and David later will talk about lithium as well. But the next slide does show some of the worst stocks that have taken place in the last financial year. We will touch a few on these as well, and we got a lot of people calling about the zips and the afterpays, Roger. So it's good for our members to know what they should be doing when the markets are like this.
Yeah, absolutely. Thanks, Chris. Yeah, certainly. I hope the audience watching it today don't have any of these worst stocks, because you probably want to look away. But yeah, mining certainly forms a big part of the growth in everyone's portfolio, and we're quite big in our mining companies. However, one thing in these volatile markets that a lot of people tend to do, and this is the old saying, and you might have a chuckle at this, but see this guy standing there looking at the clouds and standing there praying. And this is the old BHP strategy, where we call it buy a stock, hold it when it goes down, and then you pray that it comes back up. And we've all done a fair share of BHP. Even now, I mean, we all have one or two stocks in our portfolio where they've gone down, and you're sitting back and praying that they come good. Unfortunately, if prayers could be answered for investors, you know, we'll all be multi-billionaires, but it doesn't work that way. The one thing which does work is a bit of logical planning. And part of that is dollar cost averaging. This is one technique amongst many that we teach, educate, and tell our members on a regular basis is don't put all your eggs in one basket. Try and spread yourself wide, and don't buy a stock in one hit. Try and buy it in different chunks, and that's called dollar cost averaging. So whether you're buying it on the way down, as you can see in the charts a few times, and on its way up, you're giving yourself an average price, which alleviates the concerns or alleviates any risk. And that is a perfect strategy, which you may be using. If you are, great. If you're not, well, something for you to consider. So that's one takeaway you can use from today's webinar. Now, one thing we will be showing right now to you, which we're extremely proud of, is our income portfolio. Now, this is something we have been publishing for 10 years for our paid members. And this portfolio is a combination of 22 stocks from the top 200 ASX index. And these companies, now we're not showing you the names, unfortunately, because this webinar is for non-members. However, the names are usually on the left. And then you can see the prices, the dates we bought them, you know, the current prices, the return on each stock, the dividends they've been producing, and a total return per stock. And then on the extreme right-hand side, you can see the annualized return per stock. And what I'd probably highlight is the bottom right, where you can see the annualized return on this total portfolio, which currently sits at 17.1% annualized for the last 10 years as an average. Now, I've got to ask a question here. Is, Chris, maybe I'll ask you, if you were an investor and you could park your money in top 22 stocks out of the top 200, or not top 22, but 22 stocks, and you could give yourself a 17.1% return per year over a 10-year period, I assume you'd be pretty happy with that.
I couldn't agree more, Roger, absolutely. And you took the words out of my mouth. We are very proud, because the next slide will show, and you know, for all our listeners, a lot of our members are your mum and dads, retirees, Roger, so they're looking for something outside the four banks and Telstra. And this just gives you a great example of our lowest risk recommendations, Roger, who are paying a very strong yield. In fact, a lot of our members call up, quite a lot of members who are looking for dividends. And the last column there are fully franked stocks. So they're very happy to have these stocks. We give a forecast. 5 minutes ago, Roger spoke about forecasting, where we see the markets, where we see stocks. So we're very proud about the income portfolio, and it gets updated every 3 months for our members. And usually we have a really good conversation with them.
Excellent. Thank you, Chris. And I've got a question just come in now, but I'll come to that question in a moment. Just to finish with one more point. This table of these 22 stocks and shows you the forecasted dividends for the next financial year. And the column to look for is the gross yield, financial year 2023. And you can clearly see some stocks are expected to produce 7, 8, or 9%. Even there's 2 there in double digits. And there's a few which is obviously lower than 4, 5%. But overall, the portfolio average at the bottom, you can see it's expected to produce 6.6% gross yield in the next 12 months. And that is very healthy. And I can't think of any investor who'd say no to that, given where we are in the market at the moment. So the question I've just received from Jennifer, and she says, I've just sold a property recently and I've got a bit of cash and I'm looking to invest in blue chip stocks. The question is this a portfolio that you will manage for me, or is this something that I can do myself using my own CommSec account? So Chris, you speak to a lot of members. Could you answer that question? And also, how do your members typically manage their portfolio? Do they tend to copy these 22 stocks, or they tend to cherry pick a few?
Yeah, good question, Jennifer. You will manage it yourself. Most of our members will cherry pick because they probably all hold in similar stocks, but they will cherry pick which ones are going to fit their strategy. Now, what we haven't mentioned is actually a few stocks in this income portfolio actually trading below their net asset value. So not only are some of these stocks paying you a 5 to 6% dividend, but you're actually buying them at a discount from what their share price is. So yeah, you would choose which ones you like. You can call in, you can even call Roger or myself a little bit later, and we can just go through some of these stocks. But yeah, at the end of the day, our members, especially the blue chips, are looking for low risk and it's going to give them a nice yield. But obviously, Roger, they want capital growth along with it.
Absolutely. Yeah, we do want capital growth as well. So these are not just pure dividend stocks. As you saw in the previous table, 17.1% is a combination of around 6% in dividends and about 11% in growth. So all up about 17% a year. So ask yourself the question, am I getting 17% returns right now in the last 2, 3, 4, 5 years in the market? If the answer is no, then this is an excellent opportunity for you to join our service and copy this portfolio and just let it run. And every quarter we will update this. If we need to sell a stock, we'll let you know. If we need to add a stock, we'll let you know. We're currently sitting at 22 stocks. So have a think about that while we talk about something else. So Chris, you've been with Fat Profits for how long? And tell us a bit more for those people who don't know much about Fat Profits, please.
Yeah, good question. So Angus, I've been here for 11 years, but Angus Geddes is the CEO and founder. As you can see, when he was a young lad, he turned $200 into $35,000. So he knew where he was moving in his career. He's worked in many financial institutions right around the world. We can see in the UK, the US. Fast forward to 22 years later, he's now managing around $100 million. So Angus started Fat Profits in Sydney in the year 2000. We did open an office in 2003. I spent 5 years in the London office, so we've got a lot of members over there when it comes to the FTSE and the European markets. The Wealth Management division, we'll talk about that a little bit later, and we've got a little office there in Auckland. So we cover all markets. For non-members today, we cover all markets when it comes to equities, income, resources, and there's many different equity analysts, which the next slide, I will not introduce David because David can talk about himself.
Absolutely. So David, there's you, and obviously you've been with the Fat Profits for a long time. You worked in other firms in the past. So tell us about your experience with Fat Profits, and also you've seen lots of ups and downs in the markets as well.
Yes, primarily I've been with Fat Profits like Chris for 11 years now. Yes, I've been in the industry for a long period of time. I started in 1975 straight from high school as an analyst, and I have seen many ups and downs. But what that's given me is a lot of experience and a lot of eye-opening experience as well. Sometimes good and sometimes bad, but certainly I enjoy looking for the value in these sorts of markets when there's doom and gloom around. and also enjoy the possibilities of selling when there's plenty of euphoria around. So I use that experience to cherry pick, as Chris said, from perhaps people who look at our income portfolio. I look at cherry picking what we see as good stocks to fit the thematics that we generate, and primarily I have been doing that for my whole life.
Okay, well, it's great to have you, obviously been with so much experience, join us today, because I'm sure the audience is getting some value. But on a funny note, there was a gentleman, you would remember, David, your old, I'm not sure if he was workmate or a senior, I suppose, in Colonial. He watched one of these webinars a few months ago, if you remember, and he joined
Yes.
our service for 2 years. And then he asked me to say hello to you. But I think you had a story about him. He sort of burnt the office down in Colonial, was it? Or
Yes, Jim Franklin. He was in our Melbourne office for Colonial Mutual when I was a junior analyst there, and unfortunately he was a heavy smoker, and he dropped one of his butts into what was a plastic bin, and it unfortunately did cause a bit of a ruckus on the 12th floor of Colonial Mutual building, I think at 320 Collins Street. So yes, he's come back to revisit me.
yeah, he did. He watched one of these webinars and he said, "Oh, I remember David." And he called me. I remember I spoke to him and he said, "Oh, I really enjoyed David. He's been observing you from afar, but he said I'm happy to join for 2 years." He's 85, by the way, just to let our audience know. But some funny stories we've had over the years, but also to talk about our wealth management. Now, we're not encouraging you to join this today, but just to let you know that we also manage real money in the markets. And Angus is our fund manager. And here's an example of one of our model portfolios, which is the concentrated Australian shares portfolio. And you can see the orange line that represents our fund or the account, and that's versus the black line, which is the ASX 200. And you can clearly see from back in 2007 when we launched this till now, the orange worm has clearly gone way above the markets. In fact, it's nearly tripled the market return over this long period of time. And this is how wealth is created. Now, we're not encouraging you to say, give us your money. We're not interested in that. But just to show you that we also manage real money as well. Now, if you join our service, just to finalize that, we are not stockbrokers. We don't manage your money. We don't buy and sell for you. And we don't have a platform where we encourage you to buy and sell from. So you just carry on doing exactly what you're doing now, which is buying through your CommSec or your NAB trade or your CMC markets or whatever you use, and nothing changes. All you do is take on our research and we can help you with the recommendations. Now, talking about recommendations, let's give a couple of those recommendations away today because our audience might be looking to buy something. So first thing, let's talk about commodities since you specialize in this, David. First thing first, commodities are certainly affected by the US dollar, and the US dollar has been rising and rising in the last 12 months, as we can see in the charts. And while the first half of these 12 months, the commodities still were running pretty hot, but the last sort of 3 or 4 months, they've sort of cooled down a little bit. What are your views on the US dollar and the way we see commodities going forward?
Yes, look, the US dollar, unfortunately for all of us, has, and you can see from that chart, been on an upward trend, and it probably still is at this point in time on that trend line. However, we do think as a house that we have perhaps seen the top or the inflection point, and you can see there that it has come off a little bit over the last couple of months in terms of trading. It's been a rush to safe haven for investors. That used to be that I guess the gold mantra, but unfortunately the US dollar's taken that mantra over for the time being because investors were just uncomfortable with putting their money anywhere else, and that's really what has caused this US dollar to rise. The US economy, as we've perhaps seen rhetoric coming out, is not as good as this dollar would tend to reflect. It's got rising debt, it's got slowing GDP numbers, and of course it's got very high inflation. So add those all together, and we do expect that the US dollar at some point will go into a significant bear market. But unfortunately, in the near term, it's been quite a devil for resources in that they're all priced in US dollars, and as it goes up, they all fall, and that's what we've seen happen. So we are expecting the US dollar to roll over, perhaps not in the very near term. Certainly the metrics are all there for that to happen. And when that does, we will see a nice recovery, we think, not only in resources, but in gold and in a number of other sectors as well.
Thank you, David. Well, so if you're an investor with a bit of cash at the moment, if US dollar has peaked in the short term, and if it does roll over as we expect, well, this could be a perfect time for you to look at a couple of commodity stocks, because they could really go off the charts if commodity prices start to rise with the fall in the US dollar. Talking about commodities, let's talk about one commodity. But before that, we can see here, year on year, one commodity which has stood out amongst everything else is lithium. You can clearly see that green box there with 485% rise year on year. And we'll talk about lithium today, although we have coverage in all of these metals in our portfolios. However, brief look at the commodity price index first. It has risen over the last 12 months, although it has had its ups and downs, as you can expect, with the US dollar being pretty strong, but all in all has gone up. But let's talk about lithium, David. Now, lithium is something which some of our audience might have already invested in, or maybe they're looking at it. But if you're a mum and dad investor looking at lithium, what are some of the things to like about this, and why is this price going up?
Yes, basically, and we've talked about this already, listeners, in that we have a long-term thematic to do with the auto industry and the conversion from petrol-driven power plants to non-petrol or electric-driven power plants. And with that, we're going to see a significant rise in the demand for lithium as lithium goes into batteries to go into those vehicles. You'll find very little lithium in a gas-driven power plant of today's cars, but there's certainly going to be significant amounts of lithium in future electric vehicles. And we picked this thematic up some time ago, and it's that thematic that's driving this demand. There's limited supply of lithium. There is potentially significant demand growing as as the auto manufacturers tool up their electric vehicle production lines over the next probably inside of the next 5 years, but certainly from 5 years or so onwards. So that demand is really what is biting into this this chart that you can see there. Yes, as you can see, it's come off its peaks, but look at how much it's gone up compared to how much it's fallen. There could be further volatility because, as I've said, we are expecting that sea change to come through in the auto industry. It's not quite with us yet. It's just a little embryo of EVs rolling off production lines at the moment. But look, it is going to be a massive change over the course of the next 3 to 5 years. And with that, we've seen the demand for lithium spike through the roof, you might as well say.
Through the roof. Oh yes, it's blown the roof off, that's for sure. Well, let's talk about one stock in that case. This is a buy recommendation for our audience today. This is quite a large company. If you haven't heard of them, Independence Group, IGO. They've recently also acquired another company called Western Areas, and they've also released their results for the fourth quarter. Now, we've held this stock for quite some time. David, the financial shape as well as the portfolio, what do you make of that, and why do we like about this company?
There's a couple of things we like about IGO, and it fits into, again, that broader thematic that we have, and that is it's now a major producer of nickel, having acquired Western Areas recently for 1.3 billion, which it did in cash, and it did it quite easily. And it's also now a significant producer of lithium through its Greenbushes acquisition a couple of years ago. So it fits nicely within the thematic. And in fact, it used to produce gold at Tropicana, but sold that off to move into what we would call these greener commodities. So we like it primarily because it's made these two astute acquisitions. It does position them very well in two markets or in two commodities that we believe have certainly got some very good long-term thematics about them. That is lithium that we've just talked about, and nickel. And it's done it in a way that it's not really stretched its financial capacity. It, as I said, acquired Western Areas in cash for 1.3 billion. But if you have a look at it, it's only got net debt of 500 million. And with that, there's nearly 400 million sitting in cash there. So you'd have to suspect that, given that it's in two exceptionally good commodities that we think with long-term horizons, it's got good production profiles for both. It has significant cash resources. That's one of the key reasons that we like IGO.
Absolutely, thank you for that. And if you have a quick look at the charts, you can see we bought this back in 2019, $3.44, way before all this has taken place. However, in the last 12 months in particular, we've seen the stock really take off, and a bit of patience. We are medium to long-term investors, lots of patience, but we also encourage that dollar cost averaging. As you can see, we bought it a few times, and the 10K, if you'd invested there, will currently sit at $30,000. Even just one stock like that from us will well and truly pay for your subscription many times over. But look, at the moment, if you look at the share price, it's sitting at just under $11. It has been as high as $15 at its peak. So we think there is an opportunity for you to, buy this at the moment and hold it for some time to come, and you could potentially make some money and thank us later if you do. But talking about getting in early into a stock, and that's the key, David, and you've been a master of getting into stocks earlier than most other investors. There is a stock that we can give away to those who are willing to join our service today, and this is an advanced explorer of lithium, but they also have some other commodities. Maybe Chris, you can tell us a little bit, because you know this company quite well, and then you can talk to David about this.
Yeah, one of my favorites, Roger, and especially with the charts that you were showing earlier. It's an Australian-based miner. They have had exceptionally great results recently. In fact, overall, they've just recently completed a drilling program that's had much success and will continue to have success. Not worried about their cash pool whatsoever, Roger. In fact, they've got about $11 million sitting there in case of an emergency. But just in regards to the management's business strategy moving forward, we're very confident with this company, extremely undervalued. And in fact, especially with the demand as we saw with lithium and where they're going, the demand of lithium, we have no concerns at all. It's one of our high conviction buys. And we'll see a little bit later the cost of it at the moment. But we like them very much. David, what's some of the gems of this company?
Oh, look, certainly you've just talked about it. They've got a very good project where, yes, they're busily now shoring up the resource for a lithium project. And we're not flooded with lithium companies in our portfolio. We cherry pick, as I've already said, as a team. And this was one little explorer that came to mind when we were looking at the long-term advantage of being in lithium and the need for that particular supply of that commodity to actually increase in the future. And this one certainly met that criteria. So overall, it's not only got lithium, but it's also got a couple of other very good projects in a gold project as well that just recently they announced some excellent results from. So all in all, we do think that this company, like IGO, is well cashed up as a junior explorer. It has got a very good lithium project that we think over the course of the next couple of years will develop into a major lithium deposit for them. And with that, they will move through to take it to commercialization, and it will probably be delivering lithium. Yes, not in the next year or two, but certainly when lithium prices, we think, will still be at escalated levels, and that, as I say, certainly fits our thematic very nicely, and that's why we enjoy watching the moves by this little explorer.
Absolutely. So look, if you're looking for an advanced explorer in lithium, well, you can talk to us at the end of the webinar. There is an opportunity, but this stock, as you can see there on the charts, in the last 12 months alone, has turned a $10,000 investment into $51,000, and gone from 8.6 cents to currently sitting at just under 50 cents, has been as high as 73 cents. So it's had its fair share of ups and downs, but there's a lot of announcements to be absorbed. And we think at under 50 cents at the moment, if you've got 2 to 3 years time frame in mind, and you can chuck in whatever you like, 5, 10, 20 grand, whatever is comfortable for you. We don't give that advice, but we see a lot of opportunity in this particular company. So you could make quite a bit of money. Now, before we talk about a couple more buy recommendations to give away today, let's talk about stocks which we should avoid. this is just as important as buying quality stocks. So one of the things we're looking at the moment, as an example, if you look at the US inventory levels for retail or the big, wholesale companies, you can see the green line. The inventory levels have shot up to very, very high levels, and it's moved away from the retail stock quite a bit. And what that simply means is the big retailers, including Walmart and Target and Amazon, they've got no choice but to discount their stocks heavily to get them out the door. And that's not a good position to be in. And we've seen that in the Australian market with the likes of Kogan. But I'll give you some example. And this is the first time in a very long time that our world's largest online retailer, Amazon, has issued profit warnings that they're expecting the profits to go down in the coming 12 months. The forecast is not that good, and that's largely thanks to 2 or 3 factors. But one of them is certainly inventory levels. Then, of course, you've got the consumer inflation, tightening of the rate cycle, and all that sort of stuff. So, keeping that in mind, you must have a look at your Aussie retailers, and one of them is Wesfarmers. And we see a similar chart to Amazon or a Walmart or a Target in the US. They're a lot bigger than Wesfarmers, of course, but Wesfarmers, you can see that the share price has come off in the last few months. We've been avoiding this stock. We're not saying it's a bad company, but just avoiding that given where we see the backdrop. So if you're holding this or if you're not, just something for you to keep in mind that that's something we're not comfortable with buying at the moment. Another one in the retail space is Myer. And historically, look, that's been a bit of a choppy road for this company. They've not been performing well. They've had a fair share of issues. We've been avoiding this even though it looks cheap on the chart sometimes. And recently they had their half-year earnings announcement, which was actually better than expected. So it moved the share price higher for the day, but now we're seeing a bit more selling again. So should you be buying this stock right now? The answer from our perspective is we're not buying this. We see more concerns in this space in the coming months. So this is not our preferred stock. Another couple of stocks to avoid right now is AGL. And AGL, in the past, look, it's had a good run many years ago, but if you look at the last 3 or 4 years, have run into a lot of problems. Recently, they've received an offer from Cannon Brooks, who tried to buy them out. He's still lurking around, and that's moved the share price up a little bit from $6 to $8. But should you be considering buying this at the moment? Well, in our view, not. We're avoiding this company as well. And the last one for today is Magellan. And Chris, you know this company well because we bought this when you first joined our company.
Yeah, don't get us wrong, listeners. We've loved and done very well with Magellan. In fact, we recommended it just over $1 back, I think, around 2011, and we actually sold out around the $26 range. So yes, it did top up to around $70. No one's got a crystal ball. We made an exceptional profit on this company, but since then it has pulled back down to around under $15. We like the fintech sector, Roger. We've actually got a few fintech stocks in the portfolio. We'll run past a couple of them at the moment. But yeah, at the moment, if someone's asking us should they be buying it, again, our research is saying no. There's other undervalued stocks in the fintech sector that we like.
Absolutely. Thanks, Chris. And talking about our sell recommendations, now we also tell you when to sell. So far we've looked at buy recommendations, looked at avoid recommendations, and now we also talk about sell recommendations. We give you a snapshot of what we're selling, and we update you. Every time we sell a stock, we send you an alert email. And the recent one, and this is a list of our recent sell recommendations, and these are denominations of $10,000. So Chris, could you run us through a couple of examples?
Yeah, look, it's one thing to buy a stock, Roger, knowing when to sell or sell half. Our analysts and David Lennox, they do exceptionally well. And for our listeners today, you probably recognize some of the stocks here. You might be even holding some of these stocks. But the first column will show you the company, the prices that we've got in, the sell recommendation price, and the last column is a good example, Roger. We listen to our members, so if you use $10,000, that's roughly the return that you would have got if you did listen to our buy and sell recommendations. Yeah, look, we take losses. There's no crystal ball here. But the one we're very proud of, which we will just show sell half of HUB24, recommended them at $1.03, taken half this week at $23. We've had a few members call in, very, very happy with this, and we just had some conversations about what to do next.
Absolutely. So look, they're right at the bottom, HUB24, we'll talk about that next. But yeah, if you put in $10,000 per stock, look, a lot of them have done quite well. And yes, we don't get all of them right, so a couple of them losers, but generally speaking, we get it right 7 out of 10 times. Let's talk about HUB24, because some people might be holding this. Now, this is a company which is a financial platform. They also have funds under management for portfolios, for advisors, and everything that you can think of for a financial technology firm. Now, this company has become the best platform in Australia for the last 6 years running. They've received multiple awards rated by advisors, and the funds under management, as you can see on the charts there, they've been rising and rising and rising. So they're a very strong company. We have no issues with them. Now, the old saying, buy them early. And yes, did we buy them early? Absolutely. $1.35 back in 2014. So we've had them for about 8 years, and we've been patient. We've bought it multiple times over these years and dollar cost averaging along the way. But the initial buy, $10,000, we've just sold half due to some weakness in the market at the moment, and also some concerns that we have in that sector just for the time being. So we locked in half just a few days ago. And that $10,000 over 8 years has turned into $172,000. Nothing to sneeze at. It could change someone's life. It could be a nice deposit for a house today. But we're still keeping the other half because we still think over the medium term, this company will go higher. But just short term, we see a bit of concern, we're cashing in, and maybe we might buy it back if it goes a bit cheaper. But we're just being prudent. And these are the kind of recommendations we can suggest to you when you are a member of our firm. Next stock, we'll give you another buy recommendation today, is a company called Bubs Australia. So David, you know this company quite well. We've recently talked about this with our members, and they've had a major contract with a US firm. Could you tell us a bit about this company and why we like them?
Yeah, look, firstly, the image you can see, the lady on the left is their CEO, Kirsty Curran. Look at that smile she's got on her face. Yeah. And I think I know why. Look, yes, this company has done very well in the infant formula. We've recently picked it up, and we see that over the course of this year, it got a big tick from President Joe Biden in the US, which unfortunately has suffered a malfunction in a couple of their production capacity formula, infant formula producers. And they basically ran out of formula milk, and that put I guess an emergency call out around the world. And this company has a significant capacity to meet that demand, and they are now flying tins and tins of formula into the US, and we think in 2023 they'll make a significant value out of that. They've not only got the US, and they've just recently did a capital raising to actually concentrate on the US, but they've also done very well in China. So they've got two significant exposures in two major countries. And we think the share price is certainly way undervalued when you have a look at the potential that this company has. It's got the capacity to meet significant uplift in demand. It's just raised cash to focus on what's now becoming a major market for them. That's the fly-in US market. And we think that certainly will fit the thematic that we have of certainly companies that will do well when it comes to cherry picking their products in markets.
Excellent, thank you. In fact, David, we just received a comment from a member called John. He said, I remember I used to be a member of your firm many years ago. I remember listening to David through your membership podcasts and webinars, and it's great to hear you again. So, and he said he's enjoying the presentation so far. So just thought I'll pass you that feedback.
Thank you.
All right, moving on to another stock. So another stock that we're going to talk about today to hold is a stock in coal. And as you can see on the charts here, thermal coal prices have been rising and rising, and they're expected to remain pretty strong over the coming months. And one stock which we've made some significant money on in the last 1 year is a company called Whitehaven Coal. And this company, about a year or two ago, was actually in quite a lot of debt, but thanks largely to rising coal prices, they've actually benefited tremendously, and they've turned around their financial health. David, just briefly, I mean, this company must be very happy with the way things are. The announcement, the last announcement from them seemed quite positive, and the financial health is looking very good.
Yes, certainly they've used the rise in coal prices to repair their balance sheet, which did need significant work, and that's all what they've set about doing. They now have done all that, and they do, we think, going forward, will generate significant free cash flow, and with that, we can expect to see some rewards flowing back to shareholders. Yes, it's been one of those commodities that people haven't liked, but the thematic that we saw around this was that it was a recovery company. It was in a commodity where we saw, with the global world opening up from its COVID 2021 years and opening up to more normal operations, the need for electricity was going to be huge, and that turned out to be the right call. And with that, the demand for electricity required coal-fired power stations to come back on stream, and of course that lifted the demand for thermal coal, especially, which this company produces. Recently we did sell a half to lock in some profits, as we just talked about with Hub24, and you saw it on our sell recommendations list earlier. We did sell some halves, but we are now riding through with the other half, we think, for another probably year or two, and then we'll see where thermal coal goes from there. But we do like the recovery that we've seen in this stock, and as I said, we expect to see some nice payments back to shareholders that were much maligned only a couple of years ago.
Yeah, very good. Look, this is a good success story in the last 12 months exactly, gone from $2 to $6. So yeah, triple the money. Again, if a $10,000 investment would be quite handy at the moment. So we're holding the other half. Now, Chris, we publish our results. We're one of the very few companies who publish our annual returns online on our website. Can you run us through some of our performances over the years?
Yeah, and to our listeners today, you may have even seen these figures on our website. We're very transparent. We'll show our members, where the performance is, but basically the historic performance, annualized returns since Angus Geddes started the business in 2000 to now. As you can see, we average, if you bought and sold all the recommendations that we've provided, we're averaging 17.8. If you did that with the All Ords, well, you'd be averaging roughly about 8.5. So the difference over the last 2 decades is an extreme performance of 9.3%. So you can see the calendar years there a little bit lower with our mouse. Just gives you the roughly idea of what we've been doing year on year, again, against the All Ords. And we're always proud about that last column right there. So that's just giving you the difference of what we're doing at Fat Profits.
Yeah, absolutely. There's a huge outperformance versus the benchmark. And again, ask yourself the question, if you are willing to part with a small amount of dollars just to have a company like us get you double-digit returns, which you can see we've been doing it for a long time. Look, we're not perfect. We do get it wrong sometimes, but 9 times out of 10, we have done well in the past. So if you have a look at our medium to long-term compounding value, if you invested $10,000 20 years ago when we first started, and you topped up with $5,000 a year, and you got that annual return as an average of 17.8%, just to show you the value of compounding returns, that would be currently worth $1.6 million in your account today. Now, is that likely to happen in the next 20 years? Well, nobody knows, but what we're showing you here is the value of being patient, value of getting good returns from 1 year to the next and sustaining that over a long period of time. That's what creates wealth. Now, Chris, they don't have to take our word for it, because we have a lot of testimonials on the internet.
Yeah, our listeners can go on, and especially for members that are using the service. I mean, we're very proud about this. We're averaging 4.1 with all of our reviews. And, Roger, when I listen to my members about why they like it, they have full control. But at the end of the day, we just give them the direction. We tell them when to buy. We tell them when to sell. They're still making the decisions. In fact, I think Doug, I love his comment, the best thing since sliced bread. I think, Roger, we got him in a resource company, and he was very happy. So it's good to see just the feedback from our members. They're using it. We've had IFAs, we've had the retired stockbrokers in the past use us. So it's been great to just hear the feedback from members.
Yeah, absolutely. So look, definitely the investing community gives us a tick of approval because they've been with us for a long, long time. Look at this one, Penny, she's been with us for 8 years and absolutely loves our service and tells everyone about us. So a few reasons to join us today, Chris.
Yeah, just, listeners, if you've been flirting with the idea of fat profits, this page really should convince you, if not what you've already listened to. The performance there, 18% per year over the last 22 years. Save time on research. Listening to my members, they don't have the time or inclination, Roger, to do their own research. They're just too busy with their own businesses, traveling, family, whatever it might be. The experience, the reputation, we saw Angus, what he's doing with the business. You've seen David on television. You probably see him quite often on television. 7 out of 10 winners. Again, we give you daily market commentary. We tell you what's happening with the markets. We tell you where to take winners, and also forecasting as to where we feel the market and the stock is going to go. And one very important thing, we are not a marketing company. You're not going to subscribe to us and need to pay more in order to get the results. We provide, you'll see the packages very soon. We give you all the information, depends on which package you choose, and manage real money. We put our money where our mouth is in regards to providing the actual service. So here are the packages on our website. We've got a standard membership, a premium membership, and a platinum membership, listeners. All of them come with daily market commentary. So rather than going to Google Finance and trying to figure out what's happening in the markets, we'll provide you with daily market commentary. It's a really in-depth 10-minute read article about what's happening globally. Weekly, a bit like what you're doing now, but just for members, we'll provide a weekly member webinar in our Sydney studio, a bit like what we're doing now, where our analysts and Roger will just talk about what we like, what stocks we're recommending. If you've missed out on the daily, you missed out on the webinar, member listeners, don't worry. We wrap everything up in a Friday email, which we'll provide you. So the standard package, friends, will get you one report for you to choose. Most of our members, listeners, will choose the Australasian equities, and that will provide them with recommendations. Been here for 11 years, most of our members are on the premium service, Roger. This is where you get to choose 2 reports. The main reports, especially in the Southern Hemisphere, would be the Australasian equities and the global mining. As we saw with that circle, most of the ASX is based on financials and also resources. And that comes with a premium account manager. So like in this webinar, we had Jennifer and John mention something. So you can call in, ask questions with your account manager. They will provide you with the answer with their research and the research analysts. The Platinum, Roger, if anyone's interested in global markets, well, that will provide you with all of our recommendations. So the Southern Hemisphere, the Northern Hemisphere, the UK, US, it provides you with all of our recommendations globally.
Excellent. Thank you, Chris. You've done a good job there. So just to clarify, I've actually just received a couple of questions now, starting to get some interesting questions. So first one is from Jonathan. He's saying, if I'm an Australian investor only, which membership would be perfect for me? So Jonathan, just to clarify, if you're an Australian investor and you're looking for growth and dividends, we would suggest a premium membership in the middle, because that gives you access to the Australian equities report, which is weekly, and you also get the mining report, which is published by David Lennox and his team. So you will get a lot of mining companies, similar to what we've just seen earlier, and Australian equities, which has that income portfolio that we looked at previously, as well as other growth stocks across the market. So those first 2 reports will be perfect, and you'll have an account manager, someone like Chris, who's been a senior account manager with us for 11 years, who knows the markets, who can help you with clarifying any questions. So that's what we recommend. Another question we've just received is from, hang on, let me just quickly see. This is from Keegan. And the question is that if I'm looking to invest in a US market, which report? So just to clarify, the global equities report, that covers US, Europe, and Asia. So if you're looking at an international recommendations, then platinum would be the way to go, because that will cover Australia and overseas. So certainly price-wise, there's not a huge difference, and we'll show you that next. So just to move forward, this is how a Friday Fat Wrap looks like. So, I mean, this is just one of the pictures from it, but each Friday, you receive a wrap-up of the week, any highlights that Angus and David and our team are recommending. And also the webinars that we do every Thursday at 12 p.m. Sydney time, live for an hour. If you missed the live session, that's okay. We know people are busy. We send you a recording every Thursday, so you can replay the recording. Just hit that play button and you can sit back with a coffee and you can watch that at any time. So that's available, and you will definitely love the member webinars, because that's a favorite part of our membership. Now, do we have a deal for you today? Absolutely. Do we all like a good deal? Well, I don't know anyone who doesn't like a good deal. So here's the 3 offers we've put together for you today. And remember, whichever one you go with, they are fully tax deductible, and they come with a tax invoice, which we can make to your self-managed super fund or your personal name or your business name, not a problem. So let's go with the standard first. Standard, the retail price for 1 year is 1095. Nice and easy, and you can try us for 1 year, not a problem. However, we're giving you an incentive. If you want to do us a deal, we can give you a 2-year subscription, which only works out to be $14.95 in total. Average per year is only $7.95, so that is very good value for your money, no doubt about that. Or if you want the best value, you can go for 3 years, and we reward your commitment, and we drop that price down to $19.95 for a total of 3 years. That brings your annual average down even further to $665 per year. So pretty good value, no problem. However, most people show interest in premium or platinum, and the reason is very simple. The 2 years premium, we're actually offering for $8.99 per year, which is a total of $17.95. So that's definitely well worth the additional $300 from standard to premium, because you'll have 2 reports and an account manager. However, the most popular one we've found in our experience is the 3 years, where the annual average drops to $765 a year. Very cheap, and you get a 3-year subscription for that, and that's the most popular, we know for sure. And finally, the platinum, where we had a couple of questions earlier, that retails at $25.90 for 1 year. We're giving away 2 years for the price of 1, and that is a huge discount of 50%. So your annual average drops to only $12.95 a year. If you think about it, it's only about $100 a month. That's not much. Or we're offering you today as a one-off, because we've received some requests about portfolio reviews from people recently. So we put together a 3-year package where we can do that for $2,995, and that's drops the annual rate to only $999 per year. And included in that platinum service, we're happy to offer an annual portfolio review for the 3 years of your service. Now, what does that mean? So that means if you want some recommendations on the stocks that you're holding and our views on the equities that you're looking at, we can conduct a review for you where you email us your portfolio, and we will, our analysts will look at it, and they'll come back to you with some recommendations. General advice, so just keep that in mind. We don't provide personal advice because we're not financial planners, but general advice on the stocks that you're holding, whether they're a buy, sell, or hold, or an avoid. And you will definitely get some value from that, no doubt. And if you haven't had one done professionally by anyone of late, well, that would certainly be highly recommended, especially at that price of only $999 per year for a 3 years, our top level service, not a problem. So having said all that, what we'll do is, and I'll open up the question now, which should be on your screen now. And for those of you who are interested in taking up the service, you can register your interest now and make your selection. Now, while you do that, and I'm actually starting to see some interest come through at the moment. We're getting quite a few on premium, and there's a few on platinum as well. So we'll give you a few more seconds to go through, make your selection. I'll take a couple of questions now. So Chris, one of the questions just come from, another Chris actually. This is Christopher. He's asking, he's saying, I am an ex-member of yours and I'm watching this webinar because I'm concerned about the markets and I'm all cashed up. My question to you is, if I joined the service today, how quickly can I start looking at your recommendations? And will you provide me a direction on when is the right time to start buying stocks, given where the markets are at?
Yeah, good question, Chris. So absolutely. So you just choose the package. We can also have a phone call organized. You'll be able to see the recommendations immediately. So we always encourage walk before you can run. Just have a look at what we're recommending, why we're recommending it, Chris. In regards to your strategy, you might be looking at purely growth stocks, or you might be looking at more income. We can have an arranged conversation. We can just tell you what we're saying at the moment. But yeah, certainly it's just no point being in cash at the moment. We're not throwing our firstborn in the markets, but we're certainly, buying on this pullback. So yeah, maybe after this, if you've clicked one of the packages, Chris, you can just call in. You can speak to Roger or myself. We'll be happy to answer any questions when it comes to a few stock specifics.
Excellent, thank you. Next up is from Dorothy, and she's saying that I have two portfolios. One is a self-managed super fund, and one is a personal portfolio. And I haven't had anyone look at it for quite some time. It might be requiring a health check. So if I join your service on the Platinum 3 years, could I email both portfolios for you to look at? So I guess I'll answer that question for you, Dorothy. Look, we can, not a problem. We're happy to help and support. Yeah, it'll take a little bit of time just to go through both your portfolios. But if you allow a few days, we will come back to you with a date and time, and we'll do a half-an-hour appointment on the phone, and we'll give you some general recommendations on how you can position that going forward. So that's not a problem. We're happy to help you there. All right, so moving on now, I think we've got plenty of selection here, Chris. There seems like a lot of people showing interest in premium and platinum. There's a couple on standard as well. Might be some new people joining the markets for the first time. So I'll close this now. Thank you for your interest. And we'll move on to the next hidden gem. We've got one more hidden gem for today, which is a gold company. So Chris, maybe you can take it away and tell us a bit about this one.
Yeah, this is a high conviction buy here at Fat Profits, Roger. Nearly a $1 billion gold miner. In fact, we're certainly not worried about their cash flow. They've got $50 million in cash, and they have got a life expectancy mine of over 16 years. So these guys actually started producing gold in one of their mines in June this year. And we like these guys 100%. They've ticked a lot of our boxes, and the reason why they've ticked a lot of our boxes, Roger, is because they're a very cheap gold excavator, and gold is very cheap at the moment, just over $1,700 US an ounce. And you follow JP Morgan, Morgan Stanley, they can see, along with us, seeing gold going back over 2,000, and so their profit margins only continue to increase with the gold price going up. So you'll see the chart and roughly what the price is at the moment. But yeah, we've got them as a buy, and we're very confident with the resource sector and especially with gold.
Absolutely. Thanks, Chris. So David, just a couple of points I might get from you, because you're the expert of our mining sector. I mean, obviously we can't give the name away just yet, but they've just poured the first bar of gold in June, not too long ago. What's to like about this company that gets you interested?
The real standout are two things. They've got a very long life mine now. It's just at the very start of that life, as Chris said, 16 odd years, and there'll be more to add to that as they do exploration. The other is that, yes, they are a very efficient producer. The way in which they went about developing this particular site was certainly well suited and came in at a very good capital level, and that makes them a very efficient producer. So with that, we see the Australian dollar gold price now up over $2,600. They will come in at probably somewhere well below that, and that's going to give them great margins. They already have a reasonable bank of cash, and with good margins now starting to flow from gold production over the years to come. That's why we think this one's a hidden gem.
Absolutely. Thank you, David. And look, just looking at the charts here, and you guys can see we bought this a few times along with our strategy of dollar cost averaging. We bought a 16, 17, and so on. This stock has risen from 16 cents up to a higher 47 cents, so nearly tripled over a period of 12 months. However, with the recent shake-up in the markets and also gold price coming down, it's been discounted heavily from 40 odd cents down to 22 cents it went down to, but found some support where you can see the orange line and now bounced above that to trade around 27, 28 cents. Still, we think if you want to make one, pick up one stock from us today, that's something for new joining members. We will give you that today because at 27 cents, we think there's a huge opportunity if you have patience and you can hold this stock for 2 to 3 years. We see this going well past the recent peak of 47, which will double your money anyway. But we see this going well and truly north of this chart, and it could make you a little fortune, if you like, but certainly well and truly cover our small fees that we ask for. So if you're interested, please let us know. What I'll do now, just quickly, Chris, I've received a couple of comments from members saying they couldn't register in time, and they're asking if we can put up that poll again. One of them, his name is Tim, he said he was multitasking, couldn't do it. So, okay, Tim, look, we'll put up the question one more time, and there it is. You guys, if you haven't registered your interest just yet, you can do so. And look, I would probably suggest, look, if you're not completely sold, but you want to talk to someone, look, we promise we won't bite your ear off. You can tick that last box. I'd like to discuss it further. And we'll get on the phone, either Chris or myself or someone else, and we're happy to answer your questions. But something, look, if you're open-minded, and if you want to try something new, and try something to change your results, which probably haven't gone as well as planned, look, what's the harm? You've seen the prices. Give us a go for 1 or 2 years, and let us help you. You've seen the likes of David Lennox, who's on this webinar today, hugely experienced team, and we will help you. So here's an option. You can tick one of the boxes. I'll give it a few more seconds. We've got one more question here from Margaret. And Chris, Margaret is asking about commodities in general. In fact, David, I might ask this question to you. She's saying, I'm light on commodities in my portfolio and something I've been tossing up. Should I increase my exposure to commodities given the presentation today? I'm leaning a little bit towards that. Are you guys quite confident on commodities in the future?
Look, certainly we've seen a pullback in commodity prices because, as we talked about, the higher US dollar, and that does give you the opportunity to come in at a cheaper entry price than perhaps 3 or 4 months ago. So we would use this opportunity because over the long term, we can see that, as I've talked about, the broader thematics that we use, we can see those thematics and the commodities that fit those thematics. We can see them enjoying future price increases as the years roll through. So yes, we would suggest that you dollar average or pick now the right time to actually come in and perhaps start putting some commodity exposure inside your portfolio.
Excellent. Thank you for that, David. Well, look, that sums up our presentation today. If you still have any questions or you want to talk to us or you want to email us, you can email us at info@fatprofits.com.au and we'll be happy to get back to you with any inquiries. But apart from that, look, we hope that you've got some good information from today. We thank you for taking your time out. If you've made up your mind and you are going to join our service, look, we welcome you. And we will look after you and help you as much as we can in these volatile markets. And we encourage you to think it through. On the other hand, if you're not sure and you're still tossing up the idea, look, we will say, if you want to change your results, you must do something to change. So let us help you and give us a go. So on that note, my name's Roger. I'll pass it on to Chris first to say his final words.
Yeah, thanks, Roger. Thanks, David. And thanks to the listeners. We do hope that you found this information beneficial. And as Roger said, even if you didn't click on a package today, you have a question, feel free to call in. We're happy to answer any questions that you've got, but we do appreciate your time.
Thank you. And David?
Yeah, thanks, Roger, and Chris as well. I've certainly enjoyed giving listeners just a little bit of an insight into the Fat Profits investment team.
Excellent. And if you join us, you can hear David every week on a Thursday in the webinars. All right. Thanks once again, and we'll catch you later. Bye-bye.